at what happened yesterday in the market to predict what happens today? Not really, but we can use simple historical statistics to help form a bias for
Oh, sorry, I had something in my throat there. To help form a bias for today's market direction. So this indicator attempts to do just that. Now, we'll run through the settings. Most of them aren't really relevant. They're simply for your own personal preference in terms of formatting and color. There are a few that are important, so let's just whiz through those and then we'll just have a look at what these statistics actually mean. So there's only 3 inputs here that will change the dynamics of the data that's provided. The first and most important one is to define the change. The change can either be set as open to close or close to close. Let's consider this candle. Is this candle an up day or a down day? In the chart settings on TradingView, if you tick colors bars based on previous close, this is a down day. In so much as the close on this candle is lower than the close of the previous candle. However, if this box is unticked, the candle becomes green. This is because the closing price is higher than the opening price. To understand how the script is working with that setting, let's replay a few bars. The yellow arrow will indicate where the bar in question will appear. Now the counter will count the number of days either up or down that the current streak is in. Here we have 2 down days in a row. This is where the difference appears. Right now we've set to open to close. If we set to close, the script will now count this as a down day and the streak will be 2 days in a row. So the setting you choose here will have an effect on the numbers that are displayed in the table to the right. I don't think there's any right or wrong way to go about this. I would just suggest you use your instincts, but just remember, changing this setting will change the results. I've set the standard ATR length to 20. You can set it to whatever you like when comparing the ATR to yesterday's range. I've found that the changes in that ATR don't affect the statistics terribly, but if you'd like to sharpen up your view, you may want to change that setting yourself. The only other setting I want to draw your attention to is the start year and start month setting. Now I've included these for one very important reason, and the S&P 500 index as given to us by TradingView gives a very good example of why. Now you can see here on a zoomed out chart that TradingView has provided data for the S&P 500 going all the way back to 1871. Now the problem with that is the S&P did not exist as an index of 500 stocks until at least the late 1950s, and there's also a very solid argument to be made that data pre the markets going entirely electronic is questionable. Some people would even argue that data pre-2010 is questionable. So if that is you, you can limit the amount of data collected, because personally I don't want statistics for a market that did not exist. The other potential problem that this setting lets us get around is when data sets begin like this and the data is, well, patchy at best, I think you would say. So whatever data set you're using, I'd suggest you go back to the beginning of the history and just check to make sure that the data that is being provided is actually valid. Obviously I would discount using any of this data and be rolling forward until the data looks a lot more stable. So whilst the start month may not be as important, the start year certainly is important. So let's just run through what each of these statistics actually mean. Now on the top right here we have the streak table. Now as the name suggests, the streak table will show the historical statistics for market runs both up and down. Now note, as I will continue to note, these statistics are not a prediction. They are an historical representation of what has happened previously. So it's these sort of things that you might want to think about when you're forming a bias for the day. So for example, if the S&P 500 futures have been up for 6 days in a row, you can go in with a little bit of statistical confidence that historically the 7th day has been up on 63% of all the occasions. Now that has happened, as the occurrence shows, 65 times. It is recorded a 6-day winning streak. Now, as noted in the settings, if you change the type of move from an open to close move or a close to close move, those statistics will change. Next, here on the bottom right, we've got the day of week change matrix. So all this is doing is it's gone through and looked at each day of the week, and then it has worked out if the next day is up or down. So we know that the S&P 500 has a propensity to rally most days, but from everything we can gather from the data available, Thursday looks like the most likely day for the S&P to rally. It has observed 1,210 Thursdays, and on Thursdays 55.2% of those days have been up. So at the bottom we have a graphic that represents the size of yesterday's trading range as compared to the current ATR. We can see in this example that yesterday's range was within the ATR, whereas for an example such as this, we had a range that was larger than the current ATR. Now, the way that that little statistic is generated is quite simple. Each day's range is split into two subgroups, so the range is either inside the current ATR or it is outside the current ATR. Then we look at the range itself, and we divide the actual range up into quarters, and then we observe which quarter the close occurred in. Once we observe the ratio to the ATR, and also which quartile of the range that the market closed in, we can then group that close into the categories as suggested previously. Once we have those categories, so there would be 8 different categories in all, we can go back and see what happened historically the next day. So just remember, the statistic is for the previous day's candle, not the current day's candle. So here we can see that yesterday's range was within the ATR, and also the close was in the third quartile. So we go back and look at all the closes that match that description, and we come up with a historical statistic that 50.96% of days like this were up the next day. So none of these statistics are derived from each other, but hopefully you can see that a combination of those statistics can help to bring you a bias with a statistical edge historically for the direction of the current trading day. Now, just blindly following these statistics will not guarantee you success, but that is not the point of these things. The point here is to give you a bias on which way might be better to deploy any trading strategy you may wish to deploy. So if you're insistent on following some of these ridiculous so-called trading strategies that we see appear all over YouTube, then at least know statistically, historically, what has happened on the next day basis today's conditions. So this won't make you a brilliant 102% win rate trader, but sometimes in trading you've just got to settle for not sucking quite as much, and that can be enough. So I hope you like it. If there's any bugs, report them. I'll try to fix them. If you want to see anything else, let me know. Thank you for watching. I hope this indicator helps you out somewhat and just helps sharpen your edge. And we'll see you next time. Bye for now.